Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. We're continuing our series we call The Road Ahead. We're asking some of the smartest people we know what they're watching and what the future may hold. Today, we've got an extra special guest who spends a ton of time interviewing thought leaders and movers and shakers, and he's got some great thoughts of his own. Today on the Real Estate Guys radio program.
Stop for a moment. Why are you listening to this show? Are you dreaming of a bigger, brighter financial future? More personal freedom to live life on your own terms? What if there was just one skill that could make it happen? There is. Sales. Robert Kiyosaki says every entrepreneur must be good at sales. It's true for investors too. Sales is how you attract money, people, and opportunities. Sales is the skill used to negotiate deals and lead your team. Sales skills are essential to success. The good news is, it's a learnable skill. The great news is, we've created a 2-day interactive workshop to teach those skills to you. Make plans today to attend How to Win Funds and Influence People, Mastering the Art of Financial Selling. For dates and details, send an email to sales@realestateguysradio.com or visit realestateguysradio.com and look under events. Gain the skills you need to succeed. Email sales@realestateguysradio.com or look under the events tab at realestateguysradio.com.
Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms, and joining me as usual, our financial strategist and co-host, Russell Gray.
Hey, Robert.
This has been a fun series. We've been in the middle of a series called The Road Ahead. We're picking the brains of people in our world who have earned the right to have an opinion about what may be coming and what's next, and more importantly, what they're watching and paying attention to. And we've gotten good response and I think opened some minds.
Yeah, absolutely. You know, when I was a little kid, I'm old enough, and maybe some of our older listeners will remember a little publication called Reader's Digest.
Sure.
And Reader's Digest, of course, you're in that generation, so of course you remember it, but you got to remember there's a lot of millennials out there who have no idea what a Reader's Digest is. But this is where a group of editors would go through and they would glean some of the best articles and publications and put either excerpts or synopsis of it into one book where you could cover a lot of ground in a short period of time. And, you know, we spend a lot of time on this show talking about macroeconomics and the big picture and what's going on, mostly because of what happened to us in 2008 and the lessons we learned about being ignorant of that as real estate investors. But we also still have to talk about real estate and markets and niches and all that stuff. So we don't get to spend as much time as we'd like, even though we spend a lot of time talking to some of these big brains, but there are people out there who live in this world all the time, and they're constantly talking to those people. And today we get a chance to visit with somebody who spends a lot of his time interviewing a lot of the people we'd love to spend more time with, but don't have time for. And so we're going to pull the Reader's Digest out of him and share it with all of you because it is really, really important information. And you consider everything that's going on in the world right now with the global debt, the frailty of the bond markets, what's going on with geopolitics. Of course, some people think we're in a real estate bubble. We've got worst inflation in 40 years. I mean, this is a whole new set of uncharted circumstances for most of our listeners. And to have a chance to listen to somebody who's had a chance to have a lot of conversations with a lot of smart people, we're really excited to have this conversation today.
Our guest today is Adam Taggart. He's been a friend for years and a super sharp guy. He hasn't come from a real estate background. He's come from more of a traditional business and stock market background, but he is a student and he pays attention to a lot of stuff. And to your point, Russ, for the last many months, he's been interviewing just some extraordinary folks right front and center about the economy and about the trends and about this kind of stuff. So rather than bring 17 more interviews, we're going to pick Adam's brain and get the high notes of what the people he's been talking to are thinking about. And he interviews a pretty wide slice of folks. It's not like they're all cut from the same cloth, and he looks at different industries, but he loves to get in these great conversations. He's inquisitive, and I'm anxious to hear what he has to say about what he's been hearing from the people he's been interviewing at Wealthion over the last weeks and months. When we come back, you'll meet our friend Adam Taggart today on the Real Estate Guys radio program.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Real Estate Guys listeners, are you tired of losing real estate deals due to financing issues? Have you had enough of waiting on banks, lenders, and investor groups to fund new projects? What if there were a way to eliminate all the hassle and invest in real estate on your own terms? I'm here to tell you there is. Patrick Donahoe here from Paradigm Life. I'm an Investopedia Top 100 Most Influential Financial Advisor, and I recently wrote a best-selling book about the financial strategy that changed my entire investment model, and the one that could change yours. To get a copy of my book for free and learn how you can maximize your real estate portfolio by acting as your own bank, send an email to mybank@realestateguysradio.com. Don't make another real estate deal without reading my book first. Email mybank@realestateguysradio.com now to get your copy for free.
When it comes to successful rental property investing, it pays to be picky. Pick the right markets, pick profitable properties, and pick great property management. That's easier said than done, but we've got great news. Terry Kerr and his rockstar team at Mid-South Homebuyers are going strong in Memphis, Tennessee, and Little Rock, Arkansas, too. So for a top-notch turnkey single-family home rental property, whether you're a new investor or have a large portfolio already, pick Terry Kerr and Mid-South for a truly A-plus investing experience. To learn more, send an email to midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com.
Hi, this is Kevin Harrington, an original shark from the hit TV show Shark Tank, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. It is our series called The Road Ahead, some of the smartest people we know and what they're paying attention to in what is now month 2 of a new year. And the gentleman you're about to meet, we've known for many years. He's a good friend, but even more importantly, he's a good student. He pays attention to what's going on. In fact, he gets to talk to lots of folks with lots of different perspectives. Please welcome back to the Real Estate Guys, our good friend Adam Taggart. Hey, Adam.
Hi, Robert. How are you?
Very good. How are you, my friend?
I'm great. I'm really great to be back here with you and Russ. Of the many things that you kindly introduced me at, I would put at the top of the list, I'm a fan of you guys and what you do at the Real Estate Radio Show.
Well, thanks for that. And we are amazed at your continued success with Wealthion. You are prolific. Man, what a great opportunity. And before we're done, we'll make sure our listeners know how to get a hold of you there. But I think what really struck me about having you on this series, Adam, is just you talk to so many different voices in the economic space and financial world and, you know, all kinds of different parts of the financial system, if you will. And these are such interesting times. You know, everybody is unsure and yet convicted at the same time. So maybe share with us just your perspective about where things sit and from the interviews you've been doing, what's been going on.
Sure. So as you rightly said, I talked to an awful lot of people. So the whole point of this series you're recording here is to talk to a bunch of smart folks and hear what they have to say. I do not consider myself in the cohort of those smart folks, but I talk to those smart folks for a living. And it is an incredibly uncertain time. If I had to pick a word to describe what I think the consensus view of all the people I talk to about 2022 is volatility. I think the only thing we can really count on is change and really sort of hard to predict change. There's so many things that are truly different this year from the past many years that we've become accustomed to. Probably the biggest one is, well, the rise of inflation. But I would tie that to Fed policy. And this year is basically a reversal of the Fed policy that the market has become incredibly accustomed and I would say dependent upon for really about the past 20 years. You know, most investors, whether in the stock market or in the real estate market, the Fed has been your best friend over the past 20 years. They have been driving rates down to historic low levels. And I mean like over the past couple thousand years, historic low levels. And they've been willing to step in at a moment's notice if anything sort of interrupted the tranquility of their sort of just inexorable rise in all asset prices. Now that the inflation genie is out of the bottle and roaming around, the Fed is really now being forced to confront it. And of course, it's a monster of the Fed's own making. The only real tool the Fed has to battle it is to remove stimulus and highly likely to actually have to start hiking interest rates. So that's what's going to make this year so different from the ones that, you know, as investors we have in our living memory here. And right now there's a lot of parts of the system that are just trying to keep the status quo going, and they may succeed for a good while. But right now we're really beginning to see sort of the tug of war of the forces of all the intervention that's been propping up asset prices, and then the natural forces of deflation that desperately have been wanting to happen over the past 15 plus years, that are now finally maybe going to get their day in the sun as the Fed removes liquidity from the system.
Yeah, it's so interesting that over the past 4 weeks I've been doing this series, pretty much everyone starts with the Fed because it's such a looming thing. And I think for us, the connection to real estate's critical. For some real estate investors, you start talking about the Federal Reserve and their eyes glaze over. But the reality is, as you mentioned, the Fed's been wonderful for real estate, not only lowering interest rates, but inflation. Inflation inflates values of real estate and therefore rent. So we've watched this monstrous can get kicked down the road now for decades. But the big question is, for how long, and then what does it look like when it stops?
Well, absolutely. And, two things about interest rates relative to real estate. One is that we think and often talk about the Fed like it's all powerful, right? But really what the Fed is doing is it's setting interest rates at the short end of the curve. Further out on the curve, the bond market really decides what those rates are going to be in the long run. And for a very, very long time, the bond market's just been sort of slumbering. And it's really kind of let the Fed set the tune.
Yep.
But increasingly, a number of the folks I talked to, I just did an interview the other day with Bill Fleckenstein, who for a very long time has been saying what's really going to end kind of the party in stocks and the party in real estate is going to be a revolt in the bond market. And in his mind, what's going to happen, what's going to cause that is the Fed is going to get in the box that it's in right now, where inflation that it's created is run too hot. So the Fed has to start taking measures to try to tame it. But the Fed is not going to be able to raise rates as high as they're going to need to be to truly tame inflation, because that would tank the markets and it would basically pull the economy into recession. So at some point, the Fed is going to have to blink. And when it does, Bill and several others I talked to believe that at that point, the bond market's going to kind of wake up and say, you know what, the Fed is actually really toothless here. And inflation is going to really be a lot more persistent and a lot higher for a lot longer than we imagined. And the reason why that's important to the bond market is because you have to look at the real interest rate, right? You have to look at what the bond rates are, and then you have to subtract from that the rate of inflation. Well, right now, bond rates are very low, as we talked about, but inflation is very high. So if you're sitting on a bond, you're basically mathematically guaranteed to get a negative real return on that investment for as far as you can look out, right? So at some point, the bond market's going to revolt and say, look, we need higher interest rates. And it'll take them higher than the Fed wants them to go, but the Fed doesn't control the long end of the curve. So that's going to create trouble everywhere across the economy, because our economy is way too over leveraged. There are many companies that can't withstand interest rates much higher than they are right now. So it's going to have a huge ripple effect in the economy, which is, not good for anybody for a whole bunch of reasons. That's not good for real estate for a whole bunch of reasons. But specifically, it's not good for real estate because as those rates go up, mortgage rates go up. And as mortgage rates go up, prices go down.
Yeah, absolutely. Based on affordability. So the average home owner is looking at what they make, whatever they do for a job or business, and they can spend a certain portion of that according to their lender to buy a property. As investors, we think a little differently. We're looking to exploit the difference between what the rents are in an area and the expenses of controlling that property. And so with the rates as low as they've been, really, for the last decade, it's been hard to go wrong investing in real estate. Now, I've been along long enough, and you knew my dad well. My dad invested when interest rates were 10 and 12 and 16 and 18%, and they were still doing deals back then. But it was a very different reality. Loans were different. The way that people approached long-term real estate holds was different. And today, I think we've gotten so addicted to cheap money as real estate investors that it's hard to imagine a scenario where rates go up substantially. We do some business around the world, and many of the markets that we're in that aren't the United States, interest rates are typically 6, 7, 8%. And nobody bats an eye because they've been paying 6, 7, 8, even 10% in those markets forever. But people in the U.S. go, what do you mean the rate's going to be 4.5%? That's extortion.
Right. At a high level, it's a really important observation, which is, we'll talk about it in the real estate market, but it's equally, if not even more so true, just in the financial markets in general. where for the past 40 years, we've basically lived through a period of disinflation, which is basically, falling interest rates, but sort of slowing growth, right? And that's done wonderful things for asset prices as those interest rates, as money's gotten cheaper, basically.
Yeah.
And the problem with that is it's made things very easy for people, right? And the musculature that we've developed has become optimized for that type of environment, where if you just sort of bought and held, this is more common in the stock market, but it's relevant in the real estate market as well. If you bought the dips, right, and then just held on, you did great, right? Well, as that potentially flips into an inflationary environment, you're absolutely right, Robert, where the rules are different in that type of world. And we don't really have many people left, like your dad, who have the investing experience, the know-how of how to actually invest in that type of environment. So it's going to catch an awful lot of people by surprise. And you're right. I was talking earlier about mortgage rates going up, and that obviously puts downward pressure on real estate prices. That's not what a real estate investor wants to hear, but you kind of think like, okay, well, if that's going to be cyclical, I can ride that out as long as I'm getting enough money from my rents, right? Which, I'm not saying that real estate's not still going to be a good investment class going forward. I actually think it's still going to be one of the better ones in general. But you get this affordability issue, which, you mentioned the word affordability. As inflation goes up, cost of living goes up. That's both in terms of your housing costs, but it's in terms of everything else in your life. And, everybody watching this can relate to the fact that most people have seen double-digit increases in their food, in their fuel costs, in a lot of the basics for living. Households, renters, they can't afford that for too many years, but where they simply just can't pay, right? And I do think that's going to be a big trend going forward in real estate as long as inflation persists, where there is going to be an affordability limit where your renter base is just not going to be able to pay higher rates, no matter how much more that the landlord wants, unless we have substantial wage inflation, which we're seeing some signs of. But right now, I don't see it as sort of broad scale across the U.S. workforce. I don't see it right now riding to the rescue of real estate investors in terms of like, oh, people are going to be able to pay increasingly higher rates for a long period of time because of rising wages. In some ways, I'd love to be proven wrong, because real rates for workers have been stagnant for way too long in this country. But I think, especially if you own sort of higher price, rental real estate, you may see an awful lot of downsizing, people saying, look, I just can't pay these premium rates anymore, and I've got to move lower down in the chain.
We talk about recession-resistant pricing in real estate, meaning you go to a real estate market and you see who the tenants are and where they're coming from and what kinds of jobs are behind their incomes. And there's kind of a price point that's usually a little below median where, when times are good, people will move from apartments into, the nicer areas where they can find single-family homes. But when times are tough, they'll move downward. And so kind of either way you win. And we can study real estate markets because there's already real estate markets that have a high percentage of renters, and there's real estate markets that do not. I think bigger picture, getting your mind around the fact that the interest rate landscape is changing so dramatically, or at least, the Fed, where they are purporting to be wanting to raise rates. Whether or not they'll really be able to do that and what the effects will be, as you mentioned, we'll find out, right? I think one of the unique things that you're able to do at Wealthion is you interview a lot of folks, and what I love about it is you always set the big picture, kind of get their take, but then you ask for kind of actionable ideas, like what is an investor to do in these times? And maybe you can share with us some of the highlights of the things that your guests have been suggesting.
Sure. I would say, well, a couple of things. First off, they say, and they're pretty unanimous in this, that the era of passive investing is pretty much ending at this point. I referred to this a little bit, ago, where it's been pretty easy just to buy in, remain long, again, maybe buy in on dips, but kind of set it and forget it, right? And you've had an explosion of passive funds out there that have actually now created some big vulnerabilities in the market I'll mention in a minute, but they're pretty universal in saying we're going to go back again, kind of like your comparison to your dad's era of real estate investing, to what kind of old school investors had to do, which was the hard gumshoe work of finding. You couldn't just bet on a sector, buy the sector ETF, set it and forget it, and let the rising tide take care of you.
Right.
Going forward, you're really going to have to look at okay, what sectors do I think are going to do well in this type of future, and then where where are the gems in here? Where are the strong players? And really try to avoid the dogs in the sector. And that takes work that people, honestly, a lot of investors have kind of forgotten how to do just because they haven't had to do it, right? You're also going to have to be a lot more nimble. I mentioned volatility at the beginning. I would say most of the people I talk to are pretty, I won't say unanimous, but close to unanimous in the fact that there's going to be a major repricing event in the financial markets at some point in time. We have an asset price bubble across almost every financial asset that's out there that's been enabled by this cheap debt, these rock bottom interest rates, way too much stimulus flowing into the system, both monetary and fiscal, et cetera, et cetera. And they believe that it's just not going to be able to be sustained for too much longer. Some people put the crash at a few months from now, some put it at a few years from now. They all kind of agree it's going to happen at some point. But they totally agree that you can't just push all your chips for that eventuality and then just let it ride. And the challenge is things are going to whipsaw so much in the in-between that your thesis can be right in the long run. But if you put all your chips on that bet right now, you're going to get wiped out long before you actually arrive there by all the volatility. So you're going to have to be a lot more nimble going forward. And it's hard for a lot of investors to hear this because what they hear is, oh my gosh, A sounds confusing and B sounds like a lot of work. Like I haven't had to pay a ton of attention and it's been relatively easy for me. And now you're saying I'm going to have to pay a lot of attention. It's going to get a lot harder. And I think part of it is just sort of like, unfortunately, yes, that's the environment we're going to be going into. One of the big things we talk about at Wealthion, I won't get into it in depth here, but we really recommend that people work with a financial advisor that sort of understands these macro issues and can help guide them and maybe take that burden off their shoulders if they want to work, with that advisor. I think there are relatively few people that have the expertise, the constitution, the time and bandwidth to really actively manage their portfolios the way they're probably going to need to be managed going forward. And I include myself in that group of people who need to work with a professional. Even though I spend a lot of time working at the markets, I don't feel like I have all the skills myself to do this well. So I work with my own professionals. That's general answer. Specific answer to your question. People are very concerned about inflation persisting. And I would say probably more even stagflation persisting. And for those that don't know, stagflation is basically when you get, it's like the worst of both worlds. You get the high prices, the rising cost of living, everything costs more, but economic growth remains stagnant or potentially goes negative following a recession. Basically, you have super high cost of living and no job, right? Worst of both worlds.
Yeah.
People are looking for ways to protect against the purchasing power devaluation that inflation inflicts upon capital. And so people, most of the people I'm talking to tend to really lean towards the hard assets. There are certain cases in which stocks will do well in an inflationary environment, but a lot of people think, prices go up, stock prices go up. Stock prices are a great way to invest during inflation. It's not that easy. In fact, especially when inflation really takes off initially, stock markets tend to perform really poorly, and that's because profit margins are getting squeezed. So you got to be, again, you got to sort of challenge all these basic assumptions that folks have. So stocks are very iffy. And again, because they're so overvalued as well, a lot of these people feel like, you know what, you really should be reducing your exposure to stocks. Almost everybody says, get the heck out of bonds, right? In a rising interest rate environment, bonds, they just get worse and worse and worse. They've literally had a 40-year tailwind. It's been wonderful to be a bond investor the past 4 decades. It may be equally as painful to be a bond investor going forward for the next 4 decades. So in general, they say, stay away from bonds.
Yep.
There's one exception, which I'll get to in a minute, and that's long dated US Treasuries. And that's mostly as a crisis hedge. And I'll talk about that in just a moment. In the hard asset space, these people really like, and when I say hard assets, yes, I mean, real estate, I mean, owning, some precious metals, et cetera. I do also mean, though, companies that operate in this space. So of the government spending that's going to happen going forward, a lot of it's going to go into the infrastructure space. So investing in companies that build bridges and roads and things like that are likely to do well. I'd say almost everybody I talk to is pretty unanimous that commodity producers are finally going to have their moment in the sun. So these are the companies that mine metals, copper, zinc, aluminum, et cetera, oil, energy companies. Interesting that oil is back at $90 a barrel here, but the energy sector in general is still really relatively underpriced at this point in time. And of course, agricultural commodities, and then the precious metals themselves. If you look at charts showing the relative valuation of the commodity producing companies to the general S&P, they're at basically an all-time low based upon past cycles. They've almost never been as undervalued relative to the general market as they are right now. And in that sector, especially in the precious metals sector right now, it's really never had better fundamentals behind it. You have all of the reasons why the underlying metals themselves, gold, silver, et cetera, should do well going forward because of inflation, because of monetary debasement, all the regular reasons for owning it. But then the companies themselves that mine the silver, mine the gold, historically, that sector has been a really poorly run sector. It's usually been poor management, really bad balance sheets where these companies were highly levered up, where they issued just tons of shares and diluted the percentage of ownership of the investors in the companies. That's all been forced to get cleaned up over the past decade. So now these companies have the strongest balance sheets they've ever had the most experienced management teams they've ever had. And they're spitting off the greatest amount of positive cash flow they ever have. So there's just kind of a perfect storm of great reasons, compelling reasons to get into this space. And it's, like I said, it's on a relative valuation basis, it's about as undervalued as it's ever been. You can still buy some of these companies at valuations, price to sales, price to earning ratios that you could get at a company back in the 1980s, versus the 90, 100 plus PE ratios that many companies trade at now. So kind of move your gaze from the growth darlings, big techs, et cetera, that have done super well over the past, 5-10 years, and look towards these hard asset focused, building real things, taking real things out of the ground companies. And then in addition to that, expose yourself to some other alternative assets as well. Real estate is one that they are still a fan of. Cryptocurrencies is one. And it's probably a whole other discussion in itself. I think there's increasing reason to believe that they should at least be a small percentage of a well-diversified portfolio here. The last thing I'll say, and then I'll try to shorten up this very long answer I'm giving you, Robert, but is diversification. I was on a panel or moderating a panel with your partner, Russ, Robert, that Jim Rickards was on. And Jim did a really good job of explaining the importance of diversification. It really is mathematically been proven over the years that to provide superior returns, but it's just a massive risk reducer. And one of the key things that Jim was really underscoring was that people do they do misinterpret it. And, one of the examples he mentioned is people will say, well, look, I've got a ton of exposure. I've got some oil and gas over here. I've got some big tech stocks over here, got some utilities over here, got some consumer, package companies over here. I'm well diversified. And Jim would say, no, you're not, because all your assets fit into the stocks bucket.
Right.
You have 100% exposure to the stock market. So what you really want to do is you want to try to invest in multiple asset classes that do not have a positive correlation of one with each other. And that's actually one really important reason why real estate plays a big role in there.
Our guest today is Adam Taggart. We've got lots more to ask him and something to ask you as we play Real Estate Trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Too many people become victims of frivolous lawsuits and scammers simply because they were unprepared. At Corporate Direct, we use the latest legal tools to help our clients of all sizes create a strategy to protect what is theirs. Asset protection is not only for the wealthy. Our strategies and tools are very affordable and practical. Give us a call at 1-800-600-1760 or go to corporatedirect.com to see how we can help you. That's 1-800-600-1760 for corporatedirect.com.
Hey, ever wished you could go back in time and do some tax planning? Now you can, just like Marty McFly. Lucky for you, a brand new federal law just made this possible with an EQRP to get tax deductions and reduce your taxable income from last year, so you can use that tax savings to invest in real estate, Bitcoin, gold, even your own business. Whether you're a full-time investor, doctor, government employee, even if you have 5 or 50 employees, the EQRP works and is your secret weapon, and now it's retroactive. Hey, I'm Damian Lupo, and we have your solution. By the way, if you got bad advice and used an IRA for an apartment syndication, you are sitting on a U-bit time bomb. But don't worry, there's a solution, the EQRP. EQRP company is ready to help you get control of your money, kill U-bit, and help you pay way less taxes. Want to learn more about this strategy? Send an email to eqrp@realestateguysradio.com for my special EQRP report. Paying tax or letting Wall Street suck you dry is dumb. Your first step is freeing your retirement money by sending an email to eqrp@realestateguysradio.com today.
Hi, this is Steve Forbes. You're listening to The Real Estate Guys. Have fun. You'll learn something.
Welcome back to the Real Estate Guys radio program. Thanks so much for tuning into the show. We hope you're enjoying this series on the road ahead. Got another great guest next week. And speaking of next week, right around the corner is our Secrets of Successful Syndication event. It's 2 days in Dallas, Texas that we do twice a year. This will be our largest syndication event yet, and there's just a few spots left. So if you're thinking about coming, quit thinking about it and get registered. Go to the website at realestateguysradio.com. Under events, you'll see the Secrets of Successful Syndication. Before we get back to our interview with Adam Taggart, it's time to play Real Estate Trivia. Give you a chance to win a prize by knowing today's Real Estate Trivia question. When you hear the question and think you know the answer, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. The first person that gets it right gets an awesome book called Success Habits of Super Achievers. You're going to dig that. Before we give you this week's question, last week on the Real Estate Guys, we had both Brad Sumrock, the apartment king, and attorney Mauricio Raoul. We asked this: in which U.S. state did home prices rise the most in 2021? Well, according to Statista, the year-to-year median home price increase from Q3 20 to Q3 21 was the highest in the state of Idaho at 35.81%, followed by Utah at 30.2% and Arizona at 27.65%. Equity happens. Here's our real estate trivia question for this week. Which country has the population with the highest IQ? Yeah, where are there a lot of smart folks? There are brainiacs all over the world, but one particular country has a high concentration. Which country has the highest IQ? If you know or just want to take a guess, send your best guess to trivia@realestateguysradio.com. Include your name, the answer to the question, and your mailing address, because if you're the first person that gets it right, you're going to get this awesome book sent directly to you, Success Habits of Super Achievers. That's today's real estate trivia question. Now, Adam, you mentioned hedging, right? As just, and you think as from the investor point of view, that's a way to think about risk.
Absolutely.
As is diversification, a way to think about risk. If I put all my eggs in one basket and the basket does really well, I might be okay. But with the volatility we're talking about, it probably is prudent to think about hedging strategies. So take us through that quickly, if you would.
Sure, absolutely. And this is actually the biggest reason why I recommend people go talk with a professional financial advisor who's experienced, with these issues that we're talking about, because hedging plays a huge role in that. And the average investor doesn't have a lot of understanding of the common hedging techniques that are out there. Think about hedging basically the way you think about insurance. So the insurance that I buy in my, the insurance policies I own in my life in any given year, they're a drag on my savings because I'm actually spending money to buy them.
Right.
But should something undesirable happen in that year, my house burns down, I get into a car accident, I've got some sort of health issue, I'm way better off having that insurance in place, right? It shields me from, large losses for a relatively small annual price. That's the way you want to think about this. So in a volatile market like this, where there's much more opportunity to lose money by making a poor decision or having events turn against you, you want to try to have as much protection in place to minimize your large downside risks, right? Diversification is one of the ways to do that we talked about. A really simple way to hedge is just to build cash. Right? People hate building cash in an inflationary environment like we have right now. But to be honest, if you increase your cash holdings, yes, you have a guaranteed loss in the value of that cash based upon whatever the inflation rate of that year is, right?
Yeah.
Let's just assume for a second that it's 7%, which is the current rate of inflation, right? It doesn't feel very good to hold cash and know that it's going to lose 7% of its purchasing power in the next year.
Exactly.
But if the stock market drops by 30%, well, on a relative basis, you actually holding cash was a much better thing to do, because you can then deploy that cash back into that, the stock market at a later date at much better valuations than you could today, right? So cash is a very easy, simple way to do it. But there are lots of other different ways in which you can hedge as well. One is by actually investing in volatility, which it's something, again, I wouldn't necessarily encourage the individual investor just to go out there and do themselves, but there are instruments that you can use that as volatility in the market increases, well, you get a return on that. You can also hedge by, let's say most of your portfolio is long assets. You can devote a percentage of your portfolio to being short certain assets. And what short means is basically, if the market goes down, you benefit. Normally, when you own a stock, you benefit when it goes up, you lose when it goes down. Shorting is kind of the reverse of that. There's also the opportunity to use options as a hedge. And again, this is really where a financial advisor can prove their real value to you. There are lots of different strategies with options. People hear options, they think, oh, that sounds really highly speculative. And don't get me wrong, people can use options for very speculative reasons.
Yeah.
But a smart, prudent advisor basically uses them as a downside protector. And what those do basically is for a little bit of money, you're buying that downside protection. So if everything goes great, well, you're going to say goodbye to your options premium that you're paying the same way that you say goodbye to your fire insurance, premium every year, where you say, you know what, I'm glad I paid that and that my house didn't burn down. That's the right trade-off to make, right? Same thing with options, where it's a little bit of money, but it gives you a very leveraged exposure to a extreme risk. So, hopefully most years you're going to let those options expire worthless because the rest of your portfolio is going gangbusters. But if the market really turns against you big and you've got some option hedges protecting you to the downside, you can protect a lot of yourself against the majority of those losses. Again, if you're structuring the right type of option protection. So yeah, I'm glad you asked about hedging, because I think in a market like this that's so volatile, capital preservation and risk management really should be priority number one.
Great points. Now, let's talk a little bit about cryptocurrency, because when you think about volatile markets, right, that's pretty volatile. And then when you think about hard assets, boy, I know a lot of your guests have different opinions about the cryptos. What's your big picture take on cryptocurrency?
Yeah, to be super honest, I'm still learning myself. So I'm going to present myself here as a student as opposed to an expert. Look, I totally get, I'm much more experienced in investing in, the precious metals for the same reason that many people have invested in Bitcoin and Ethereum and many of the other cryptos to date, which is, look, I'm worried about what's going on with the world's major fiat currencies. I'm looking for basically an alternative currency that will retain its purchasing power much better, right? And so, the cryptos, if you look at them across the scope of their existence so far, well, they've done a great job, right? I mean, Bitcoin's appreciated by thousands and thousands of percent. It's been one of the best investments ever, right?
Yeah.
Now, there are people who have invested in Bitcoin last year that might disagree with me. That bought in at $65,000. Now it's at around $37,000 or something like that a coin, right? So they're sitting on some pretty big losses. For certain, crypto is a speculative, highly volatile asset class. So don't go in there with money that you need to absolutely have available to you tomorrow, right? What I'd also say too is what I've learned is that most people in the crypto ecosystem to date I'm going to get flack for this, but they've largely almost kind of given up on the alternative currency. Like, this is a currency that's going to take over the dollar as the world reserve currency. I think the odds of that happening are pretty low, especially as the central banks begin issuing their own CBDCs, which is central bank digital currency. Think of like a digital dollar that the Fed is offering, right? And they've really hung their hats on the store of value argument that, hey, there's a limited amount of Bitcoins here, and people can easily share them with each other. And this is going to be, and we know, especially with Bitcoin, that there's never going to be more than whatever it is, 21 million of them. And it's going to hold its purchasing power way better than the dollar. That may very well prove true. Then the argument becomes, well, who's going to do that better? Is that going to be Bitcoin? Is that going to be Ethereum? Is that going to be Dogecoin? Is that going to be, go on down the list, right? And each group has their own argument for why they're going to be the best one. That may or may not come true. And I think it's not a bad idea to have some little part of your portfolio in there just in case that proves to be true, right? If Bitcoin goes to $2 million, you probably want to have a little bit of exposure there just in case. But really, I think the big opportunity in crypto is really the platform as a distributed ledger, which will enable commerce to happen on a platform where it can basically perform transactions better on the new distributed ledger platform than can be done elsewhere in the world. And I'm old enough to have lived through the internet revolution. I got involved early in that. And I saw the migration of a tremendous amount of commerce go from the analog world to the digital world onto the internet. And it did because it just made much more sense. It could be done much more effectively and efficiently. Well, the blockchain and other distributed ledger technologies enable that same migration from both the analog world and the internet-based platform to a new platform where it can be done with less friction, with more value creation and more cost savings. And so I think that is relatively inevitable. I think that we can argue how much of today's commerce is going to make that migration, but I think we can both agree it's going to be a lot of it, right?
Right.
And so I think there's a really interesting opportunity right now for investors who do the research, and it does take a fair amount of research, to be able to kind of buy, like, if this is the economy of tomorrow, this is where tomorrow's companies are going to be. Just as you had back in the late 90s and the early 2000s, you have the ability at this point to kind of buy into the Googles and Amazons of tomorrow, like you could buy them today at 2002 prices. You're able to get them at what should be just fractional valuations to what they're going to be in 5, 10, 20 years. So I do think there's a pretty phenomenal opportunity there. There's going to be you're going to have to take kind of a portfolio approach, where a bunch of the companies you buy go nowhere or die, but the few ones that really make it big are going to provide gargantuan returns. There are services out there that are dedicated to helping people sort of try to pick the wheat from the chaff. And I analogize this to the gold mining stock industry. There's gazillions of mining companies out there, most of which are going to go bankrupt or be dogs.
Yep.
But the ones that do really well, and we're familiar with guys like Brian London. This is his job, is to help guide people to the ones that he thinks are going to do well. If you can build a portfolio that's well stacked on ones that turn out to be, the successes, you're going to have phenomenal returns. So this is very, very equivalent to that. And if anyone's sort of interested in this, I'll just say I recorded a video on exactly this topic a couple of days ago on Wealthion. And the punchline is that you can get a free 40-page report that just kind of begins to kind of walk you through this process, especially if you're brand new to crypto and don't know that much about it. If you're interested in learning more, you can get that report.
Well, and that's a great segue, because before we get you out of here, do share with us kind of where you're headed this year with Wealthion. Some amazing interviews that you've already done that people can avail themselves to, but you continue to get great guests, have awesome, candid conversations. Tell us about what we can expect from Wealthion in the year ahead.
Thanks, buddy. Yeah, it's funny. Sometimes I just pinch myself when I wake up that I get to do this for a living, because I really do just get to talk to my heroes. And what's fun is the bigger names that come on then attract even bigger names who are willing to come on. So we're kind of enjoying that snowballing moment at the moment. But we just did a conference, was like a weekend ago, where we had Lacey Hunt, we had Jim Grant, we had Jim Rickards. We had Luke Roman, Danielle DiMartino Booth. We had Brent Johnson. We had Ivy Zellman, who we haven't even talked about yet, but she's one of the foremost housing analysts. And she's wonderful to follow, folks. If you don't follow her already, you really should. She is just whip smart and got her finger, closest person I know, or the person I know with her finger closest to the pulse of what's happening with the housing market nationally. And she's got a couple of concerns going into 2022, just to reveal the punchline here. Parts of all those conferences will make it their way to our public YouTube channel on Wealthion in the next couple of weeks. I just interviewed Felix Zuloff. We're going to have Jim Rogers early in March. We're going to have Mark Faber right after him. It's just kind of this steady drumbeat of really some of the best and brightest minds in money and the markets. So you're listening to this program and you don't know anything about Wealthion. I would say if you're trying to figure out how to navigate the next year or two in terms of trying to both protect your wealth and then maybe find some opportunities where you can position yourself to actually grow it, but with prudence, given all these macro issues that Robert and I have been talking about here. That's what we do on the channel on a week in and week out basis. And really what I do, I don't have any sort of agenda that I'm trying to push. I don't have a particular worldview I'm trying to get these speakers to agree with. I'm just sitting down with them and giving them the opportunity to share with us what they see ahead given their deep expertise in their own particular, domain of speciality. So it's think about it sort of like it's a bad analogy, but it's like Charlie Rose before the sex scandal, but just focused on the great minds in finance.
Yeah, it's great stuff. So keep up the good work and keep the good content coming. There's Adam Taggart. We sure appreciate your input today, and good to see you, my friend.
Always a pleasure talking with you guys. Thanks so much, Robert.
We're talking about the road ahead. What's it going to look like? More when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Registration is now open for the Real Estate Guys 20th Annual Investor Summit. Imagine spending an entire week with like-minded investors, world-class educators, and real-world professionals. Returning in 2022, the editor of the Gold newsletter, Brian London, international real estate developer Beth Clifford, the author of The Creature from Jekyll Island, G. Edward Griffin, Jim Rohn's 18-year business partner, Kyle Wilson, and the rebel capitalist, George Gammon. And joining us live and in person for his 10th Investor Summit, best-selling author and the Rich Dad advisor for real estate, Ken McElroy. Plus, lots more to be announced. It all begins June 10th, 2022 in beautiful Belize. Visit realestateguysradio.com and click the tab that says Summit to reserve your spot. Go to realestateguysradio.com, click Summit, and make plans to spend a week with the Real Estate Guys, George Gammon, Ken McElroy, and an all-star faculty on the 20th Annual Investor Summit on Sand.
With everything going on in the world, don't let your lack of financial understanding derail your investments. Real estate investors need to see the bigger economic picture. The Federal Reserve, bonds and interest rates, precious metals, oil and gas, cryptocurrency, and the inner workings of monetary policy, just to start. If you're at all confused about how and why market metrics intersect and what it means to you as a real estate investor, take your understanding to a new level with the Future of Money and Wealth video collection. Discover the opportunity to hedge against inflation, deflation, and stagflation. Gain critical insights on real estate niches that perform well in challenging times, and learn specific strategies to fortify your balance sheet before it's too late. Simply send an email to future@realestateguysradio.com for all the details. The Future of Money and Wealth includes 20 videos of powerful presentations and panel discussions featuring Robert Kiyosaki, Peter Schiff, G. Edward Griffin, Dr. Doug Duncan, Simon Black, CPA Tom Wheelwright, Brian London, Dr. Chris Martinson, and many more. Email future@realestateguysradio.com today.
Hi, this is Tom Wheelwright, best-selling author of Tax-Free Wealth, and you're listening to Real Estate Guys Radio.
And welcome back to the Real Estate Guys radio program. Thanks so much for tuning into the show. Hey, if you want to see a really awesome market up close and personal, join me for the Belize Discovery Trip. It is almost sold out. 1 or 2 spots remain. If you're interested, you can go to the website at realestateguysradio.com under events. And while you're there, you'll see all the places that the Real Estate Guys will either be appearing or the events that we produce. We'd love to meet you. Well, awesome to hear from Adam Taggart today.
Yes, Adam has tremendous insight. All the time he spent with Chris Martinson, who kicked off this series for us over at Peak Prosperity. And Adam's been published in many places, best-selling author, but now he's doing all these interviews through Wealthion, and it's really interesting to hear him kind of digest all of that and put it into perspective. He talks about uncertain times. Well, obviously we're facing all kinds of uncertain times. And I think the big thing that's uncertain is really how can the world react to this inflation? The last time the inflation genie got let out of the bottle, we had a strong balance sheet. We had very little debt. There was the capacity in terms of incomes and balance sheets to be able to absorb really high interest rates, which ultimately is what then Fed Chair Paul Volcker took us through. We had prime rate over 21%. I mean, there were mortgage rates that were well into the double digits back in the time. My very first rental property was nearly 13%, and that would be unheard of today. And yet you have to wonder, in the environment that we have with so much global debt, could any type of significant interest rate increases really occur? I'm not convinced, and we're going to find out, but it just is interesting to hear Adam talked about how he thinks inflation are going to put downward pressure on rents unless wages are able to keep up in real terms. That's really important to real estate investors. So if all this stuff seems kind of heady to you, it comes right down to Main Street, and you need to be paying attention to it because it does affect your tenants. They don't have the ability to benefit from inflation. They're victimized by it, and ultimately their victimization can end up in your cash flow, which affects you.
I think a lot of times the Federal Reserve gets painted into a very negative light, and for obvious reasons. But to hear Adam's take that real estate investors should be super happy about what the Fed has done for the last 20 years because interest rates have gone lower and lower and lower, and inflation means our real estate is worth more. So, just the perspective on that. And as we're watching what happens from here, we do have to pay attention, probably more than ever. And this was one of his points. You can't just set it and forget it. You do have to pay attention, which is why we always talk about broader picture economics on this show. Yeah, we're interested in real estate. We invested in real estate. We understand meets and bounds and inspections and market selection and putting together your team and all that stuff. But we also have noticed that there's plenty of other resources to find out a lot of those granular details. And so I think our mission is to help people kind of assimilate a lot of this. And we won't belabor this series for much longer, but it is a chance for us to get our heads out of the real estate weeds and up a little bit into the financial clouds.
Well, we spend a lot of time also talking about syndication. And for those of you who are either syndicating now or intend to, really understanding how to talk about investing broader picture to people who aren't into real estate so that you can attract their capital into real estate, into your deals, you do need to understand a little bit about what they're talking about. Adam talked about the era of passive investing is over. In other words, the idea that set it and forget it. I'm just going to invest in an index mutual fund and forget about it, wait 30 or 40 years with a long-term buy and hold. Of course, if you look at the charts over time, buy and hold is really you gain a lot, you lose a lot, you gain a lot, you lose a lot. And maybe you have kind of a long-term gain over time, but is that going to keep up with inflation? So he's saying you're really going to need to do your homework and prospect for value. Of course, real estate investors understand that. That's the nature of the beast. Any real estate investor is always out looking for the undervalued property in a specific neighborhood or a market that has gone under the radar and is going to be the beneficiary of net immigration or new business coming in. We've seen a lot of that. Florida, for example, has had huge growth at a time where places like California, Illinois, and New York have been floundering. And so real estate is very inefficient. That's what we love about it. And people who are investing in paper assets and stock market, bond market, mutual funds, things like that, they don't have the benefit of what real estate really allows people to do. And then when you combine that with this idea that he thinks stagflation is a real possibility, maybe even a probability, and that hard assets are the answer. I mean, obviously, if anybody goes back in the archives and listens to this show for the last 10 years, we've been talking about commodities, energy, precious metals, agriculture, in addition to real estate, with real estate being the foundation of a real asset investing portfolio. The fact that a guy like Adam, who lives more in the paper world, is thinking that the world is waking up to our world and maybe going to migrate that way. Shoot, if you're a syndicator and you understand how to tell that story, I think there's a good chance for you to be able to attract a lot of capital into your deals because you're in the right asset class at the right time for what's going on in the world.
Well, I would love to tell you we have lots of tickets available for the Secrets of Successful Syndication first weekend in March, but we don't. We're in a really cool room. It's a tiered theater room that we've not been in before. And when we looked at the size of it, we thought, it's going to be plenty big. And yet it's not, because this will be the single largest Secrets of Successful Syndication we've done. So by the time you hear this, we may have a waiting list, but we may have a spot or two left. If you've been thinking about parlaying your experience into going bigger using other people's money, or you're the kind of person that does want to passively invest with people doing bigger deals, then come on out to the Secrets of Successful Syndication. All the details on the website at realestateguysradio.com. Big thanks to Adam Taggart for taking his time today and for all the time he spends interviewing lots of great folks. If you're interested in what he does at Wealthion, just send an email to Wealthion. That's Wealthion, Wealth, Ion, Wealthion at realestateguysradio.com. Next week on the road ahead, we're going to hear from one of the smartest women we know. She keeps track of all kinds of things when it comes to economics. She spent 9 years inside the Federal Reserve in Dallas, and she pays attention to real estate. Danielle DiMartino Booth, next week on The Real Estate Guys. Until then, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South home buyers, low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct, asset protection strategies for real estate investors from attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.